We're very excited to be here today. I'm Abbie Cross. I'm a native Iowan. I've been working in the credit union industry and with Financial Plus for almost 9 years now. Like Katie said, currently in the branch manager role, also on our advocacy team, and a strong believer in people helping people.
And I'm Jordyn Henry. I am also a branch manager at Financial Plus Credit Union. I've been in the financial industry for about 9 years. My first job was a teller job at a national bank, but in a small town. So just kind of want to go into that a little bit further with you guys, just to kind of show the bank perspective compared to the credit union perspective, just so then that way it'll kind of give you guys an understanding of why a credit union is very important. So I was a teller, like I said, got promoted to kind of like this product specialist, and then ended up moving to Des Moines about 4 months after that happening. And the national bank that I actually worked for did not have any branches in the Des Moines area. So I was looking at those Wells Fargos and, you know, US banks and all those large companies, and just not having any real success on finding a job. So I took a job as a new account representative at a small local bank that was super close to my home. And I really did enjoy working there. But one of my coworkers was talking about one of their family members that worked for a credit union. And I didn't even know what that word was, what that meant, and was just really intrigued by the things that my coworker was saying about things that they did there. And it all just sounded really interesting. So I started doing a little bit of research on credit unions. And after doing that, I just decided that that's where I wanted to work. I wanted to work for a credit union, and it just seems like a super, fun place to work. And there was always fun things going on, and they, had things about their members and just doing things that seemed like that's a happy place to work. So I actually applied for a job at a credit union here in Des Moines. And I actually took a teller position rather than a new account position because I wanted to get into that company. I wanted to get into the credit union world, and just knew that I could work my way back up, and that's where I wanted to be. And that's, kind of what happened. And so I fell in love with the credit union world and their mission behind everything that they're here for. And coming from a national bank to a small local bank to a credit union, I can tell you that there's night and day differences. And really, from the fees, the interest rates, like the friendliness that you feel when you walk into a credit union, come kind of compared to a bank where everything's quiet and you just can't talk. And I can tell you it is a big difference. And credit unions are what's best for their members, and I think that's what really sets us apart. Even if I feel like if everything was still structured the same, we really want what's best for our members, and we're here to support our members. And that's, as branch managers, what we tell our staff. If you are not here for the members, then we don't have a job. That's why we're here. So kind of with that, going into that, Abbie is going to give you an overview of how Financial Plus Credit Union was established.
A brief history. Financial Plus Credit Union is a nonprofit financial cooperative. In 1929, Financial Plus opened its doors as Meredith Credit Union, so people could get something better. At this time, banks were mainly for the more affluent community. Many times when the average person needed financial help, they had to rely on loan sharks who charge outrageous interest rates. At this time, the credit union movement was becoming very popular. Members deposited their savings in the credit union, and that money in turn was loaned to people in need of credit. Profits were returned to members of the credit union in the form of better rates and more financial services. Over the years, the things that help us stand out from our competition include better rates, fewer fees, free checking, and exceptional member service. Today, the credit union philosophy of people helping people still guides Financial Plus. Also want to let you guys know that since we are a cooperative, we actually have core principles. So we're kind of aligned with each other. Some of the main ones are democratic member control. So members of a co-op organize and control the group and decide who can lead the co-op. At Financial Plus, every member is an owner, and even they can even elect a volunteer board of directors. Information, education, and training. Cooperatives educate their members so that their members can best help the co-op develop. Financial Plus works to educate the community through partnerships with the school systems and community events. Financial Plus also has an advocacy team that speaks to government officials and spreads the word on the advantages of cooperatives and credit unions. Concern for our community. All of the policies put forward by a co-op should reflect a concern for the community around it. Through advocacy, Financial Plus lends their voice and resources for not only issues that directly affect our institution, but also issues that concern our community members and their overall well-being. So a couple topics that we're going to go over today would be auto loans. That was a question or a topic some of you guys had interest in. So on the screen, you should see that these are comparisons of $20,000, and it goes to show you the difference of the interest rate. So on the top, you have 12%, so that's a pretty high rate. I would say the only time that you're going to see that rate is if you might have some blemishes on your credit, so you've had issues in the past. The one below 2.75, that's a pretty low interest rate. And you can see that overall, at the end of that 5-year term, you're going to have paid over $5,000 in interest compared to if you would have got that lower rate. So that's something very important to look at when getting an auto loan. We do have a couple tips for buying a new car because we get this a lot. Getting pre-approved, I think, is a very good place to start. It helps you build a relationship with a loan officer, and that loan officer, especially at the credit union, they're going to have your best interest. So we're not there to get rich, to buy a second home, a vacation home. We're just there to take care of our members. So that will also help you get your figures together before going to a dealership. So if you have a $300 a month budget, you don't go to the dealership and look at something that's going to cost you, $500, $600, and be way out of budget. Do your research. Knowledge is power and can help you with your negotiating. Shop around. So spending a couple more hours on comparing maybe the same type of car at a different dealership can actually help you save thousands. Buy based off the purchase price, not the monthly payment, just because what we're seeing with the monthly payment is terms and the rate might be too high, so they're trying to extend that to get you where you want to be at a monthly, for your monthly amount. Avoid impulse buying. That's when you have buyer's remorse. I always recommend sleep on it. Make sure you still feel about it the same way in the morning. There's going to be a lot of extra products that are going to be offered to you at the dealership. Credit unions actually have those same products and usually at a lower price. I would say 9 out of 10 times we are able to find you something that's comparable or if not better. A down payment isn't always required, but it never hurts. Helps you keep your payment low and can actually help you from going upside down later on. And then can also help if you don't have credit.
Okay, so the next thing that we're going to cover here, and then do keep in mind that if you guys have any questions, you're welcome to send those over to Katie in chat, and then she can kind of stop us. And we'll also have questions at the very end of this. We'll make sure we leave enough time for that. So if anything that we talk about, you have questions about, jot it down, send it in the message. We can either stop or we can talk about it at the end. So that was just kind of a brief overview on auto loans. Now we're going to go into credit cards. So sometimes credit cards can seem like they are presented in a bad light, and there is ways that it could possibly get into a negative situation. So we want to talk about credit cards and how they can actually be beneficial for you. So it's very important that you make sure that you are finding the credit union or the credit card that fits your needs. And that might be with a credit union, that might be with, a Chase or a Citi card. So just do your research and figure out what has the best options for you. So for understanding credit cards, the purpose of ideally getting a credit card would be to help build your credit. So having a credit card out there and having that revolving line, it is great for building your credit. So that's kind of the first place, if you don't have credit, would be to get a card to start building your credit up. And the importance of building your credit with a credit card is that whatever your limit is, so if your limit is 1,000, then you want to make sure that whatever balance is left on that card each month needs to be half of that. So $500 would be the max that you'd want to leave on that card at any given time. And then if you were to spend, you know, $800 or 1,000, that's fine. Just pay it down to at least that 500, and that's kind of that ideal mark to make sure that it's still helping your credit and not hurting it or keeping it from moving up. So just keep in mind too that there are shared secured credit cards, and we do offer that with the credit union. So say that you are someone that doesn't have credit, maybe haven't been, you know, at your job for at least a year or two, so it might be harder to get you approved for that card. If you actually have funds available in your savings account, for example, we can hold those funds so that they don't leave your account, but that you don't have access to them, and we can secure a credit card for you. And we typically say that you would keep that card for about a year, and then we would re-qualify you and then just release those funds where they're back available into your account. It doesn't change anything with the card option that you have. It just gives you that ability to get that card now rather than having to have a cosigner or wait for your job history, so you can start building credit right away. So that's a good time too, if you get a tax return, to maybe use some of those funds to secure for that card, and it would be about a year, and then we could release those funds as long as everything went okay with that card. The other thing to make sure that you're checking on is interest rates on credit cards. So they can range from 0% for promotional periods, so they're typically not a 0% for the life of the card. It's just going to be during maybe a 12-month period, or there'll be different promotions sometimes offered on cards. So make sure that you're looking at the interest rate, and if you're planning on ever leaving a balance, that you are putting that balance or leaving that balance on your lowest interest rate card. So I did a little bit of a comparison on the screen for you just with the two cards that Financial Plus offers. So we have our regular MasterCard, and then we have our MasterCard Rewards card. And so it just kind of shows you the interest rate difference. So the regular MasterCard, our lowest rate is at 9.75% APR. And then our MasterCard Rewards is at 11.75% APR. So there is a difference there because you're getting rewards back on that rewards card. So that's why the interest rate is a little bit higher. And another thing to check into is if you are balance transferring. So if maybe you have a card that has a high interest rate balance and you're transferring it over to this 9.75 or 11.75 interest rate, double check when you're researching cards, because sometimes on balance transfers, they'll charge you a higher percent interest on those balances, or they might charge you a balance transfer fee. So make sure that you're checking those things if that's something that you're looking at doing. Make sure that you're checking what their grace period is, and that if with that grace period that within 25 days, if you pay that balance off, you won't have any interest on that. And then if you do a cash advance, just keep in mind that typically on a cash advance, the interest rate is going to be 2% higher on average. So that would be if you are physically swiping the card to get cash back off of it. You're going to have 2% back on that. So if you go to the grocery store and you have your debit card and you say, oh, I want to get $20 or $40 back, you can do that with a credit card. But if you do, you're going to pay roughly 2% higher. So just keep that in mind. Definitely check to see if there is an annual fee. So an annual fee is something that I would say that you should steer away from, just especially if it's your first card or just starting out. There really shouldn't be an annual fee unless you're getting into cards that have super incentives, and so there's a reason behind that, or the annual fee covers maybe some travel expenses or things along those lines. And then always check too about minimum finance charges. So this could range anywhere from where ours is a minimum of 50 cents. So if you only have $15 on there, you're going to get at least a minimum of a 50-cent charge. And there's some card companies that have a minimum of $50. So that might be a good thing to check if you're comparing cards and trying to figure out which one fits for you best. And then with the rewards, check what those rewards are. What percentage you get back. So for us, we get 1.5% back on all purchases. And then also find out what you can redeem those rewards for to make sure, is that beneficial for you? So for ours, you can get cash back, you can apply it to the balance, you can travel expenses, there's airline tickets, gift cards, all kinds of things with our cards. So if you're looking at that, trying to get the rewards, and make sure you're looking to see if those redeemable options are what's going to fit best for you. And then the next thing that we have here, it looks like we're going to go into personal loans.
And ladies, I had a question just come in. Is there a way to build credit without using a credit card? That's a great question. Thank you for sending that in.
So there are ways to build credit without using a credit card, but typically you're going to fall into that auto loan category. You're going to fall into a personal loan category. And the downside to that is that those are typically a little bit harder to get approved because they're normally larger dollar amounts. So an auto loan is going to be kind of your easiest route because it's a secured loan and that there's a collateral to it. But there are some guidelines that we have to follow to get you approved. And so we might need a cosigner if you have a 0 credit score, or we have a first-time buyers program, but there's quite a few qualifications that you have to meet to get there. So as long as you meet those first-time buyers qualification, then yes, you don't have to get a credit card. You could go straight into an auto loan if you're more comfortable with that. But typically with the credit card, it's kind of that good starting point for us, at least with the credit union. Like, okay, let's do this $500 card. Let's, see how you do with it, and then, do that for 6 months to a year. And then if you don't have a cosigner or you haven't been at your job for an extended amount of time, then that's then where we can show and be able to say with our underwriting for the loan that, hey, they've shown us that they're capable of using this card, not maxing out, making the payments. So yes, we're going to do this auto loan for them without a cosigner.
Another loan that you could look at would be like a share secured loan. So that's when you have the funds. So let's say you have $1,200 in your savings account. We can actually put a hold on that amount. So we secure it through that way. Let's say you do 12 months of history, 12 months of payments at $100. That would then also build your credit. So those are guaranteed approval. So that's why at the credit union, we do recommend the share secured loans for first time buyers or the share secured credit card. And it can also be done not just on a share, but if you have a CD. So let's say you have a 2-year CD that's just sitting there, you can technically use that as collateral as well. So there are a couple different options before than just the credit card, but it is good to have a diverse credit report too. So it just shows that you're able to make those payments and handle that, because that is what we're looking for when we're underwriting, making sure you have credit established and what types of credit you have out there.
Thank you, ladies. That was a great response. And just a quick reminder. Oh, sorry.
If we don't have any other questions at the moment, then we'll move on to we'll move on to personal loans.
No other questions at this time. I do want to remind folks if they would like to chime in. I know in the last session we did have a couple of folks that were able to and wanted to speak on their own. I should have mentioned that sooner, but if you do want to ask a question yourself, you're more than welcome to, of course.
Okay. So I will go into personal loans. So personal loan is also known as a signature loan or an unsecured loan. No collateral is being used to secure the loan, so the rate is higher and the terms are usually shorter to help cut down the risk. Personal loans can be used for multiple things, such as consolidating debt that is at a higher rate, medical bills, home improvement projects, auto loans, or even a vacation. When getting a personal loan, pay attention to the rate. So in this example, 11.5, which might seem high, but for an unsecured loan, that's not too bad. So this example, $4,000 is going to cost you about $132 a month for 3 years. At the end of the 3 years, if you ended up following that amortization table to a T, you would have almost paid $750 in interest. So by borrowing $4,000, it's actually going to cost you $4,750. So compared to if you would have had maybe the money in your savings, it wouldn't have cost you so much. But definitely an option. They are out there. And then, so we kind of already touched base on it, but you can also borrow the funds from yourself. This is a way to make sure you pay yourself back. So that's why some members want to do that. Usually it's only, for us, it's 2% above whatever we're paying you. So just to make it easy, if we were paying you 1% on something, your rate would be 3%. So a lot lower than the 11.5, and it ensures that you actually put that money back in savings, because sometimes we don't trust ourselves to do that. So the credit union is basically able to do that transaction for you.
Okay, and then the next thing that we're going to cover here, because we kind of covered the shared secured loans with that question that came through, and the importance of, you know, if you were to maybe put $2,000 towards this $4,000 loan out of your savings account, that would cut that interest in half. So really the importance of being able to kind of save that money up, or at least half of whatever it is that you're trying to do, really will help you in the long term with the loans. So the next thing that we're going to cover here is mortgages. So I'm going to just kind of give some more helpful tips on this and kind of things to be looking for. We do not do mortgages. Abbie and myself do not. We do offer them with Financial Plus. So I did reach out to our mortgage officer. His name's Eric, and just kind of asked him, you know, what were the important things that we should make sure that we should tell you guys. And so the things that he said that were the most important were a down payment. So understanding that a down payment is typically required, and that if you don't have a down payment, that could then cost you to have to pay roughly between $40 and $120 additional on your mortgage payment for insurance. So if you are not paying at least 20% down on that home, so if you're loaning more than 80% of the value of your home, then there is what is called Pmi Insurance, which is private mortgage insurance. And that is actually just insurance through the mortgage company or the credit union that is just covering them to make sure that that is paid, that if something were to happen or default, that they are covered. So just keep in mind that you want to make sure that you're putting a down payment, and then making sure that he wanted you guys to know that, you know, if you're working with a credit union, you need to, you know, really keep in mind that if you build a relationship with a credit union and a mortgage officer, they're going to make sure that they're sitting down with you and making sure that this home that you're wanting to purchase is in your goal, and how long are you going to want to stay there, and is this in your best interest, and making sure that they're not just approving you for the max amount because that's what they can do and they want to get those loan mortgages numbers on the books. They're really going to talk through with you what you're looking for. And then with the down payment, there's, you know, only a requirement to roughly 3 to 5%. So it's not that you have to put 20% down. It's just that if you want to try to avoid that extra cost for that insurance that's on there, then that's where you want to try to put at least that 20% down. So not required, but it will save you in the long term to save up for that. And then keep in mind that sometimes your mortgage would be kept within the credit union, or it might be sold to another company, which is kind of like the secondary market. So it's ideal to have your mortgage stay within the company that approved it, just so then that way you can make those payments directly with that company, that you're not having to then, you know, find out, well, who did my mortgage get switched over to? And the nice thing about Financial Plus is even if your mortgage were to get sold on the second mortgage market with us, you can actually still make the payments to Financial Plus, and then we'll send those payments off to that company. So it's like it's still with us, even though it's not necessarily physically here with us. So that's a plus side to working with a credit union compared to maybe a larger national bank, or maybe a kind of off-name company that might sell it to somebody else. And then on the slideshow here, it just kind of explains that making sure that you're checking the rates. So just like with an auto loan or any kind of loan that you're doing, making sure that you're checking around on rates to make sure that you're getting the best rate, and also not being scared to say, hey, well, this credit union's offering this rate, can you guys match it? Because that is definitely things that we look at doing. So don't be scared to say, hey, this is what they have, can you do the same? And then really utilizing the calculators, and we have quite a few on our website that are super helpful for you to put in there. Okay, if I were to buy this house, you know, for $100,000, what's my payment going to be? What are the closing costs? So there are costs associated with doing a mortgage that typically can be added into the loan amount. Sometimes there is an upfront cost, and typically that's anywhere from, you know, $500 to $800 upfront. So just keep that in mind. And then I have a link here on this PowerPoint that would go directly to our website here with Financial Plus. We have a great kind of resources page, and I'm going to try to click it here and see if it'll take me without going anywhere too crazy. We'll see if it'll pull up for us so you guys can kind of see this. This on our website I think is amazing. So if you have questions about mortgages, understanding them, we have a resource tab that is just super helpful. It actually even breaks down, it will break down specific words that are normally talked about within mortgages. Trying to get it to scroll here. So some calculators, understanding your property, loan rates, understanding the application and what that process looks like, understanding the closing process and what happens afterwards. But this glossary here is super awesome. It just really will go specifically into words that you might see within the mortgage side, and sometimes even just the loan side, and give you a brief understanding of what those words mean. It's super helpful. So if you have any interest in that, then you can go directly to our website and definitely take a look at that. Sorry, I'm just getting back into that. Make this bigger for you guys. So that is over here. I also have kind of what the rates are. These were our rates as of yesterday. So just keep in mind that mortgage rates do actually change daily. So also getting locked into a rate is very beneficial when you're doing a mortgage, because that guarantees that if you applied for that loan today, but then tomorrow the rate jumps up to, you know, say 4%, which is a pretty big jump, but could happen, then you're locked into that 3.12 15-year rate. So it kind of just shows you the 15-year at 3.12, the 20-year at 3.37, and then the 30-year at 3.50% APR. So that just kind of shows you a 15-year, a 20-year, and a 30-year. And then there are other options of like a first-time buyers program. There are different mortgage options other than just a standard conventional. So definitely check with your mortgage officer. Reach out to ours if you have questions or interested in any of that. Okay, and then the next topic that we're going to cover here is going to be savings. Okay.
Alrighty, so there's lots of saving options. There's or different types of savings. So there's long-term savings, there's short-term savings. So we'll kind of go into the long-term here in a minute. But either way, savings, it's very important. It's going to provide you security and peace of mind knowing you have money available if needed. It is there in case of an emergency. It could be an unexpected car or home repair or medical emergency. could help out in the case of a job loss or reduced hours. Having a savings account could save you hundreds or thousands in interest and prevent you from having to take out a loan to borrow those funds or charge on a credit card. Savings can also be used for fun purchases. You can save up for a vacation or the latest must-have. Some helpful tips on how to save. My favorites are set up a payroll deduction. This will help make sure that the money actually goes into the savings account. It prevents you from actually having to go in there and do anything, so it's kind of out of sight, out of mind. Set up a separate account at another institution. This is my favorite just because I work with my funds all day long, so it's easy for me to just go up to a teller line and take it out. So another institution has the same hours as us, so I really have to make sure I'm thinking about taking money out before I do. It also helps with impulsive buys. A good way to kind of get a head start or a jump start on it would be using your tax return, because sometimes once you have that, once you actually have something in there, it kind of helps you stay motivated to keep putting more in the savings account. Side accounts, or Financial Plus, we call them special purpose accounts, to keep things separate. So I have like my everyday, like my emergency funds. So if something were to happen to me or my job, I have those funds that I can rely on. A few weeks ago, I finally put in a new patio, so I've been saving up for that. And once I used those funds, it made me feel a lot better because it was separate. It wasn't my daily emergency funds. Just made me feel much better about that, getting that done. And so that would be more of a short-term goal, because sometimes it can be a little hard to stay on track of saving. So having those littler goals kind of help keep you on track.
Okay, so then the next thing that we're going to kind of follow into that I think is going to be helpful is a budget. I'm trying to get back to that screen. It looks like we got jumped ahead a little bit here. Okay, so a budget. So the best thing about what you can do when creating a budget, trying to save money, trying to grow a savings account, is to live below your means. So just because you have $2,000 per month that you have, you don't necessarily have to spend all of those funds. So making sure that you're putting money into an emergency fund, car, tire replacement type things, even if it's just $10. So kind of on this here, I have, what your home expenses are. So your rent, your mortgage, insurance, electricity, gas, water, phone, cable, all those things that you kind of, need to have on a daily basis. Then your daily kind of grocery, personal items, clothing, going to eat out, getting your hair cut or those kinds of things. And this I just did is kind of an example for you of how you can create your budget and just figure out, okay, how much money am I going to allot to, what types of items, and then keeping in a budget of, like a vehicle loan and that auto insurance and the gas that takes, and then keep in mind that you have your registration and your license that happens every year. So you really need to make sure that you have that pre-planned into it. So then that whenever that letter comes in the mail from the treasurer's office saying, you owe $500, you're not like, oh crap, where am I going to get this $500 from? Where if you pre-plan for that and put that into a savings account, then you're already like, oh, yep, I will take that money out and send that check in or pay it online or whatever is convenient on that. And then the savings side of it, in the sense of your emergency fund, which would be an account touch, and that's just if something really drastic happens. And that's why Abbie was saying it was kind of helpful to have that maybe at a separate financial institution, so then that way you're not tempted to gain access to those funds, and it is more of you've had thought process into why you're taking those funds out, and you do have to kind of go out of your way to get those funds. But then having a regular savings on your personal account, that if you do need to quickly get to those funds and move them over, then you can. That's great as well. And then just making sure that you are pre-planning, for any kind of possible things that could happen in your life. Kind of this other tab is what I have here, so that if something comes up, then you do have that, but it is easily accessible to you. And then always making sure that you are contributing to retirement. That is a big importance at such a young age, to making sure that you're having some kind of retirement account, which we'll go over a little bit further here after Abbie covers kind of student loans.
Yeah, so I do apologize because I know student loans was another topic that there was interest in. Jordan and I are not very knowledgeable on that subject, just it's not something that we do on a daily basis. We're partnered with Sally Mae, but basically our services, everything is done through them. It's just someone that we're more affiliated with. So some kind of like helpful things that, or tips that we found helpful would be apply for all grants, because free money is always a good thing. And what we kind of see a lot in the credit union is sometimes since you're not sure what that student loan payment is going to be monthly, let's say you're still in school or your loan payment is still deferred, we see members coming in and they're making big purchases without having that already budgeted. So if you're able to calculate what your student loan payment is going to be after it's deferred or once you're out of school, I would highly recommend doing that. Just if you get your hard to then change things around. And I'd also say make sure that if you're able to make payments while they're deferred, to do that, because interest is still accruing. So just because you're not making a payment on that yet, that's nice, but interest is still accruing on that whole principal amount. So a lot of times on a credit report, we see that someone borrowed, let's say $3,000. It actually shows on the credit report they owe $3,500 because the last 4 years that loan has just been sitting there accruing the interest. So even if you're able to put $25 towards it a month, $50, anything is helpful and will definitely help pay it off faster.
Yeah, I would just say making sure that you're checking for forgivable loans, you know, checking all options that you have to be able to, you know, not have to get a typical standard, you know, interest student loan. I know that it might seem like a lot of work or a hassle. I remember whenever I went to college, I was like, I don't want to do all these essays and all this stuff. But, you know, now later in life, luckily I was able to pay mine off. But I have friends that have student loan payments that are $600 a month. I just couldn't imagine if I had to pay a $600 student loan payment on top of a mortgage or rent, and then a car payment and just all of those other things. So really check into all of their options, that their grants, forgivable loans, just really check all of your options.
I would say, and only take what you need. Just if they're going to let you have, you know, $10,000, that's great, but remember that's $10,000 that you have to pay back. So only take out what you actually need. So if you're able to live at home, you know, you shouldn't be taking out funds for housing. So just kind of be more aware that anything you take out, you are going to have to pay back unless it is some kind of grant.
Okay, so then the next thing that we're going to go into is IRAs and 401ks. And so I have a Roth versus traditional. I know that this was also a topic that you guys were interested in. This is kind of another topic that we, as Abbie and I, we do not, you know, handle these as much on a daily basis. So I did reach out to CUNA Mutual, which is Credit Union National Association. That's who we go through for all of our 401k, IRA investments, and they work with outside companies as well. So if this is something that you're interested in on your own, you're welcome to reach out to them. There is a phone number down at the bottom there. If you have more in-depth questions about this, we do have resources that if you guys have questions, then we can reach out as well and then get back to Katie for those for you guys. But just understanding kind of the difference between Roth and traditional. So for the Roth, for example, you pay income taxes on your contributions now. You do not pay any taxes on earnings as your account grows. Your Roth account earnings may be distributed tax-free when you take them out. That's if you have held your Roth account for at least 5 years and you're at least 59 and a half. If you anticipate being in a higher tax bracket at your retirement age, the tax-free treatment of your Roth earnings may be more beneficial. If you have a long-term retirement, then the extra time to accumulate that earning could potentially increase the value of the tax-free treatment of your Roth withdrawals. And then there's the traditional, which I feel like is kind of like the typical, that's what you normally see. And then the Roth one was kind of developed to kind of not have to affect your tax brackets. And so with traditional, you get immediate tax break on your contributions and only pay income taxes on contributions when you take them out. You do not pay any current taxes on the earnings as your traditional account grows. Earnings on your traditional contributions are always taxable. If you anticipate being in a lower tax bracket when you retire, the immediate tax break of the traditional contribution may be more beneficial. So the downside to the traditional, which there's not a downside either, but the difference is that the traditional, once you take those funds out, then that could put you into a higher tax bracket. So then you have more taxes taking out. But if you know that maybe you're going to be in a lower tax bracket, then the traditional is the best option for you. But if you're going to be in a higher tax bracket, then doing the Roth and already having those taxes coming out, so then that way when you pull those funds out, then that's not going to hopefully put you into a higher tax bracket. And that's really the most that I have for you. There are some handouts that we got from CUNA Mutual as well that I have given to Katie that she'll upload for you guys kind of into your resources tab that you have there. And if you guys have additional questions, we can try to get you in contact with someone, but you're always welcome to reach out to CUNA Mutual as well. They're super, super helpful and very nice. So.
Absolutely. Hey guys, this is
questions that they know the answers to pretty much everything. So no question for them is something that they shouldn't be able to help you with.
And this is Katie. I just wanted to add that those materials are uploaded. You can access them now or after the training. Some of them are graphs, and part of the reason I included those is so that you could see them really clearly and analyze some of that information. But it's super important to understand the difference between this Roth and traditional. You know, when you're looking at your retirement savings, and I'm sure these ladies will continue to get into that, but just understanding that difference. For instance, I invest in both because I find some significant value in paying the taxes up front and deferring some of that payment to later as well. So I'll let you guys continue, but I just wanted to add that in real quick.
Awesome, thank you. So these are just a couple charts that were actually used with the presentation from CUNA at Financial Plus. So they come to Financial Plus, they meet with all of our branches, they talk about IRAs, 401ks, they're just super informative and helpful. And these two really stuck out to me whenever we had that, because the importance of it is starting right away is going to be so impactful. And it just kind of shows you, so this one here over on the right that says start saving early. So the purple line says if you start at 25 compared to the green line where you're starting at 35 and putting the exact same amount, the same yield percentage amount of 7%, how much you're going to grow there. So there's about $100,000 in difference just from 25 compared to a 35 doing the same exact kind of chart there. So that just kind of shows you $100,000 is quite a bit of money when you're going to retire, and that's what you have to live on, and you know, for the rest of your life. So I just really saw that impactful whenever they showed that to us. And then the one over on the left here is just kind of showing you there are different types of kind of portfolios or investment types of IRAs and 401ks and investments in different ways. And so just kind of showing you the difference if between the age of 25 to 65, which is that bottom, and then at 2% earning, you know, you're going to get 147,900 compared to the one above that, which was 25 to 35, which is, you know, a lot less time. At a 6%, you're going to get 192,600. So that's where sometimes it's beneficial, kind of how Katie was saying, she's got a Roth and a traditional. If you're going to go more into this kind of portfolio, a little bit more investment side of it, maybe doing some in a 2% and some at a 6%, because there is more risk and the higher interest yielding. So the longer that you keep the funds in that higher risk, the more profitability that it is going to come out in the positive for you in the long term, where that 2% one has little to no risk, but it's just not growing as fast. So that's where not putting your eggs all in one basket and dispersing those out to make sure that you are getting, you know, the most bang for your buck. So the next one is above that is 35 to 65 at 6%. And that individual would have 201,100. And then the top option, which was 25 to 65, so just starting, you know, right away and keeping those funds in there until 65, earning 6%, it's 393,700. So I just feel like that's kind of helpful to kind of show you by starting right away is the best option. Just keep those funds going in there. Even if you, maybe the company that you work for, if they don't offer it, doesn't mean that you can't go through CUNA or any other company to start it on your own and having those funds come out of your account. The other thing to really look at when you are looking to, you know, work for a company is, do they have those accounts and do they match funds? So that's another thing that's going to be really important, is if you put in 2% of what you make, if they'll match that 2%. And it's normally up to a certain percentage that they'll do that. And so that's just free money into your pocket. But the other thing that I learned at a young age that I did not know is that if you don't stay with that company for a certain amount of time, then you actually don't get that money. They take that money back out. So, you know, some companies it's 2 years, some companies it's 7 or 10 years or 5 years. So really look into that, because it's kind of sad whenever you maybe switch to another company and you're like, oh, yep, I'm going to move my IRA funds over. And then you're like, where's all my money that I thought I had in there? And, you know, so that's things that I didn't know at a younger age that is just helpful too, to keep in mind that to be fully vested might mean that you have to work there for at least 5 years or 10 years to get those dollars that they've been putting back in there for you. So that is kind of all we have for IRAs. I wish I had more. I hope that was helpful for you guys and gave you some insight, or if it wasn't helpful, maybe it gave you some questions. So that's the good part of it, is that maybe we helped put some questions in your mind. So looks like we clicked on something here. I don't know what I clicked on.
Well, I'm sorry, I'm not much help with this tech stuff on the Mac side. But if we want to, what we could do is flip over to my screen real quick and I can pull up your relationship to money.
Okay, yeah.
Let me do that.
Okay, thank you, Katie.
No problem.
Okay, so this is kind of a brief overview of your relationship to money. So Abbie actually attended a training that she found super helpful that was put on through CUNA and the Iowa Credit Union League. And that is kind of making sure that you understand how your relationship to money does affect maybe how you save or how you don't save or how you spend money or how you think about money. And so these were the kind of 4 topics that really help put into perspective. And sometimes when then you figure out what your relationship is to money, then you can figure out either how to change it, how to keep it the same, or how to grow within that. So what beliefs did you inherit from your parents about money? So kind of the ones that we pulled up here is money doesn't grow on trees. It's just money. I can make more of it. We can't afford that. So that's kind of things that the way that your parents looked at money or talked to you about money might either go one way or the other. Maybe you're like your parents and it's like, nope, I need to keep all my money, I can't spend it. Or maybe because your parents didn't want to spend their money, you're like, no, I want to spend my money, it's mine, I want to enjoy it, that's what I work for. Or maybe, you're someone that you're kind of both sides. You're like, oh, I see where my parents were saying that savings is good, but I also, want to have a little bit of fun with my money. So maybe you know that and you try to be both sides. The other one would be, what do you remember most from your childhood about money? So this is kind of a big impact too, whether or not you saw stress around money, if there were arguments about money, whether it was talked about at all, having an allowance and then earning it. So if you're having an allowance, then that's more of something that maybe it's given to you just because, not that you necessarily earned it for any reason, but we're giving you this allowance. This is what you can spend you can spend this money on whatever you want. It's yours to have, compared to maybe if you have to do chores around the house to earn that money. So these things will kind of mold you into how you look at money. If you think about money on a daily basis, if money stresses you out just because that's how you grew up with money, or if to you, money's not even a thought because it was just never something that was brought up or talked about with you. The next one is, how important is money in your life? So this is kind of where then this falls into what you remember most about childhood with your money, and then how it affects you on your day-to-day. So does it control your thoughts? Does it control your daily activities? Does it affect your mood? I'm kind of that person that if I don't have a specific amount in my account, then I'm just stressing out about it. Or Abbie has kind of been part of me remodeling a house, and the process that it took for me to be able to pick out the furniture that I wanted, because I wanted something specific, but I didn't want to pay a bunch of money for it. And then the thought of all of that money coming out of my account that I've been saving for, even though it's for the house, but it's just, that's how my brain works, is I like seeing that money sitting in my account. And I have to find what that happy medium is this everything I want for the best money that I can get it for before I can make that decision. Where, if someone, like, I would say my mom is the opposite of that. My mom is like, I want that. That's what I know what I want. And I don't care that if it costs, extra $100 because I can get it right now today, rather than maybe waiting a month for it to possibly go on sale. So that's just kind of how maybe it affects your mood. It controls how your daily activities, whether you do purchase something right away, or maybe you're going to think about it for a week or two, and how it might control your thoughts too, in the sense of, maybe people around you, maybe there's people around you that are going to lunch and eating out every day, and you're like, oh, well, I'd like to go, get McDonald's or Wendy's every day, but that's just not something I can afford. So how do you make decisions on spending money? So whether you're spontaneous, planning, giving, or for status purposes. So these are kind of the main points of how you make decisions. So kind of based on how I was telling you guys, I'm a planner. So I plan on how I spend my money. I do have a little bit of like spontaneous, if I decide that, you know what, I haven't spent anything, I just want to buy something for myself, then I might just go on a whim and do that. But then sometimes I have buyer's remorse for doing that. And then there's giving, where maybe you're someone that would rather spend your money on someone else, maybe spend your money on a family member, or take your friends and go out to lunch and pay for their lunch. Or is it a status that, okay, because someone else is doing this, now I need to do this, kind of like maybe if everyone else is going to lunch, then I feel like I have to do that. And so then that's where maybe sometimes you could get yourself into that debt situation, or putting that balance on that credit card to try to keep up with that status that maybe people around you are holding. So it's just more to get yourselves thinking about how you think about money. What is your relationship to money? You can actually go out and Google relationship to money, and there's all kinds of things that you can read and look at. So I would suggest you guys to do that, just so you can understand how you look at money and why you do the things that you do with your money. And then now I think we have questions. I think we went a little bit over our time that we had planned, but if anybody has any questions, we're happy to stay on and answer those.
Oh, no worries, ladies. That's perfectly fine. I did have one question come in, and it's basically asking for a summary of your presentation, because when we talked initially about planning, it was like, let's cover all of this information and make sure we give a high-level overview. If you had to narrow that down, what are your top 3 pieces of advice for early 20-somethings regarding building and protecting financial security?
So building and protecting financial security, I would say kind of the top important ones that I would say, and then I'll let Abbie maybe do hers and maybe she agrees. But I would say saving, budget, and retirement. So for financial security, those are the main things. You want to make sure that you are putting money into a savings account. It's so important. I just can't stress it enough. Putting yourself on a budget is what's going to keep you on track with that. And then making sure that you are putting money into investment, retirement of some sort for later in life. It is really sad. We see some members that are on Social Security only and have no other retirement. And it just breaks my heart whenever they come in and they need a loan. And just unfortunately, because of where their income is, we can't get them approved. And it's just heartbreaking. So it's just, you have to make sure that you're planning for the future and that long-term life and what happens after that.
Yeah, I would have to agree with Jordyn. Definitely the savings, like you said, retirement. It's so important. Like she said, with loans, we kind of see a little bit of everything, and the amount of applications that we get for small purchases. So it might be, $500, and someone doesn't have those funds available in their savings to them, and they can't understand why they're being denied for, it's only $500. And I feel like we say only $500. To some of us, that's, pocket change. And for some of us, that's, that's your, that's keeping you from being homeless or something like that. And with our advocacy work too, that's actually a bill we're trying to help with too, just because the amount of Iowans that don't have that little cushion to fall back on it's very crazy. So yeah, savings, if it's only $5 every paycheck, do it. You get a pay raise, you're able to do a little bit more, add to it. Same with your 401k. If you get let's say you get a 4% increase, go ahead, put another 2% towards it. Because the things that you're doing now are definitely going to impact the way that you live later in life. So like she said, Social Security, it's, I couldn't live off of it. So I would say savings is definitely important.
Fantastic. Well, thank you so much, ladies. I do really want to appreciate you for your time and effort today. I want to offer up one more opportunity to ask a question. If somebody would like to ask that personally, now would be a good time, or to shoot one to me via chat. You're more than welcome to. If you have questions afterwards, you can also put that in your evaluation as you exit. That's not a pop-up notification. That's an opportunity for you to give your feedback on this and what you'd like to see in the future as well. So please take a moment to do that for us. I'm not seeing any questions at this time, so we'll go ahead and close things out. And we'll look forward to seeing you guys next week as we talk with a board panel about some of their career experiences and especially their experiences within the cooperatives. So thank you very much again and take care. Have a great week.